Hello, I'm David Richards. Welcome to the Digital Forge podcast. Today, I have Dan Ridsdale, Global Head of TMT at Edison Investment Research with me. Welcome, Dan.
Very nice to be here. Thank you, David.
So, Dan, you're a city analyst, an equity analyst. What does that mean? Explain it.
Okay, so an equity analyst's job is to analyze companies. So their job is to be an expert at the companies that they look at, to understand those companies, and to be able to explain what those companies do, and analyze their investment case for the benefit of the investment community. And those investors can be institutional funds, they can be retail investors, depending on the firm. So the job is about understanding management, understanding the products, understanding the technologies, understanding the market. An important part of the job is forward-looking. So one of the key elements of being an analyst is when people invest in a company, they're not investing in a company now, they're investing in what a company will be in the future. So thinking about what the growth drivers are, what they need to succeed at to deliver that growth, building a financial model to look at the picture and what that company should look like in a few years' time, and then relating back to what that might mean in terms of the company's valuation in a year, 2 years, 3 years' time.
So how do you get to be a city analyst? How did you get there? What was your career?
Well, I think my route is pretty untypical, I would say. I actually did apprenticeship out of school. Did an engineering apprenticeship. Yeah. So I straight into an apprenticeship, mechanical engineering, and then I was sponsored to go to Polytechnic, Portsmouth Polytechnic, and then I went on to do a master's in France in robotics, and from there into software, there into market analysis, and then into research. That's not the typical. How'd you become an analyst? I think the most common route now is accountancy into equity research. Some people join straight from university. I personally think that a more of a diversity in terms of educational background would benefit the community.
Well, I could go off on a real tangent here, which I'm not going to do, but the accountancy thing tells its own story, and it's a weakness actually in the British, in my opinion, in the British investment community, where the comparison I always use is in the US, 60% of venture is allocated by people that have actually started a business before. In the UK, it's only 5%, because the route in to not just being an analyst, but to investing in general seems to be accountancy. And it's just back to, so you did an apprenticeship from A levels, from school or whatever. So you didn't want to go to university by the sound?
No. I was always on a program to go to university. The fact that they were going to give me some money to do it was going to be helpful. And I got training in how to weld and turn and draft and all of those things, which I've frankly never really used since then. But I thought what it gave me was, I think, a work ethic, also a sort of grounding in that you're lucky to have the option of an education, so use it. And then after that, I think the opportunity to go to France and do my master's over there was just another step which broadened my horizons, and probably going into the city wouldn't have been an option if I hadn't done that master's step.
So it is an advantage. That journey was an advantage to you, actually experiencing the real world, doing a proper job and all that before you, and I say proper in inverted commas, before you went into the city.
I think it's advantage for me. Every analyst looks at the different companies in different ways, and for me, I like small companies. I like technology companies. I like entrepreneurs, but I like to understand how they're taking technology and commercializing it and taking it to the market. So for my route of analysis, I think it's been core to what I do. Certainly, there are very successful analysts who've gone the accountancy route as well, right? So it's key to what I do. I wouldn't have said it was a key success factor for everyone, right?
Yeah, it is interesting. And one of the questions when you were talking there, I was just thinking that, is it still the case that the city has such a lot of public school educated, the Eton Harrow lot? Are they? Mm-hmm. I mean, I know in the 80s and 90s that it was certainly there was a lot. Traditionally, the city has been that was the sort of rite of passage. I think has that changed?
Probably not enough, I would say.
Okay.
The city is making efforts to change. Certainly, in terms of gender diversity, it's getting a bit better. In terms of ethnic diversity, getting a bit better. I think in terms of educational background, I would say less so. I think that's a little bit of push and pull. I don't think there's enough financial education, focus on financial literacy and the markets in state schools, and that's something that we do need to focus on. I don't think people in state schools are choosing to go that route. And probably a bit too much pull, and I don't think it's blocking people, but often people come in because they get an internship from a friend who's from a sort of, who people have worked with, and it sort of perpetuates you that way. The other factor that's just hampered the diversity is just the city. Certainly, my area hasn't really been hiring that much. We've not been in a growth mode for at least 5 years, right? So there's just not many new analysts who've come into the system.
Yeah, we'll get on to state of capital markets in a second. But in your career as an analyst, have you always covered tech?
Always tech, in its broadest term. Yeah. I'm tech first, then an analyst. I would say. I've covered internet and telecommunications, and all different semis. I started off actually as a hardware analyst, but always tech. Yeah.
Have you ever got anything spectacularly wrong?
Oh yes, yes. I mean, as an analyst, analysts you do. In actual fact, very few analysts are right more than substantially more than 50% of the time. I think the job as an analyst is to just communicate the story as best as you can. And actually, for me, there is a lot of focus on price targets and recommendations and so on. And there used to be a lot more. And I remember my early days as an analyst, my holidays being ruined when stock you just said buy on had just had a profits warning and things like that. That happens. It does. You've got to be prepared to get it wrong. But I actually found when I did get it wrong, and you spoke to investors, and you didn't hide when that happened. You explained what's happened, where you got it wrong, how you think it's going to move from here. People actually sometimes appreciated that more, the fact that you're not hiding, and they actually recognise what's happened. But a lot of it's about, it's not just about getting that call right. I mean, ultimately, investors invest the money, and to be honest, every analyst has their own skill sets. As I talked about, I've always sort of been at the tech side. Some people are forensic accountants, some people are, supply chain experts, and so on. And investors do get to sort of know which analysts have strengths in different areas. And actually, there's one analyst that people often talk about it who just consistently got things wrong, but people valued it because he was consistently the wrong side, and they almost called him up as being a counter indicator. But it is about that communication. It's being that bridge between companies, understanding management, understanding the technology, and communicating that and helping investors understand the business and investment case.
And there are instances where you can get something right but be wrong about the share price. And a good friend of ours, Dan Ridsdale, and autonomy. Why don't you just explain what happened with autonomy?
Well, absolutely. I mean, autonomy, it was the poster child of the English, of the British tech industry. It was probably too involved for the podcast, but it was sort of almost a predecessor in terms of the AI side. It was, it was a Cambridge spin-out business, and it was always growing quickly. It was winning big accounts. It was, as I said, it was the sort of probably the highest profile growth company in the UK after Arm. But the cash generation was never what it should be, and the sale, and there was always talk about the sales and accounting practices being very, very aggressive. And there were analysts, including Dowd and Paul Morland, who flagged and were flagging this and said, "Look, it's a sell. The accounting's wrong, etc., etc." And they were actually right but wrong, because Hewlett Packard came in and bought the business. I think it was an all-time high, but it certainly generated money for the shareholders at the time. And it was only subsequently, right, that Hewlett Packard found that not everything was what they thought it was, and lawsuits followed and convictions followed. So they were right but wrong.
Yeah,
that's the way.
Which of course is interesting, because it's probably unique in your industry.
It happens. I mean, you might be right but wrong, because the cycle changes. Right, suddenly people get really enthusiastic about a sector, and the multiples go up. And sometimes there's not a hugely rational reason for that happening. And some people are very good at spotting those trends. So. I mean, as I said, you can only know what you know and explain what you explain things to the best of your ability.
So I write a column for the Yorkshire Post, and last week I covered the secret language of the City of London, and we'll talk about that now. So the way that companies communicate to shareholders is via something called the Regulatory News Service, or an RNS. And people that are not familiar can read an RNS, and it looks like it's, the company's doing really well. The share price goes down 20% because they've just had a miss. So let's just talk about that language. And an example is trading broadly in line. And give us some other examples of how companies communicate that sound to the general public like it's doing really well, but in actual fact, it's a language that's used in the city to mean something else.
There's a language. I mean, broadly in line is the most commonly used one. Often companies start with strong strategic and operational progress, and then the numbers are disappointing, right? There is a language, and it's one of my frustrations. It's not unique to the UK, but I think the UK needs to look at it. It's not all about language, but if you want more people to understand your business and to be able to invest in your business and to see if something's going very right or very wrong quickly, which is something that helps people invest in your business, then people need to make things clearer. And having this language that sort of keeps management happy, I guess, and but everyone else, all the key investors know what it means, but other people don't, actually ultimately reduces the investor audience in the business. For example, US investors, right? I mean, a lot of them are familiar with they're very bright people, but there are investors who don't invest all the time in the UK. They want people to be straight shooters. The other thing that happens in the US is people report quarterly. One of the things that is quite unique to the UK is that there's a very close relationship between the analysts who are brokers and the company, and often management have signed off the numbers that they go out in the market, and companies only report every 6 months, right?
Yeah.
Whereas in the US, management will never see the forecast that the analysts are putting out, and they report every quarter. So if you miss a quarter, it's not good, but people will look at it and they'll say, look, is this important? It's a big miss. Is it fundamentally, do I want to cut my holding, or do I want to hold on? Do I want to buy more on the dip, whatever that is? And people get over it and they reassess. Whereas in the UK, you're only reporting every 6 months, and everyone knows that's the number you were aiming for anyway. It's probably a number that you thought you were going to beat, but you haven't beaten it. So a miss lives with companies much, much longer than it does in the US. And so when companies miss their forecasts, they get kind of punished for it for 2-3 years. And actually, especially in tech, growth isn't linear, right? Sometimes a miss means a lot. Sometimes a miss means nothing. if a company, if it's about the timing of a deal that came in one side of the year, you don't often know that until the year after. But it's one of the things we try to decomplexify. And when I'm writing research, we try and focus on what the key value drivers are, the growth drivers, and if the numbers come out one way, if they're not. Sometimes companies beat, but it doesn't really mean much because it's a one-off thing and so on. And I think you need to be upfront about that as well, because the share price can go too high on those events. But I do think that a byproduct of the sort of staged management of the UK financial community does mean that there is a risk aversion, because you get punished so much for when things don't quite.
I was, when I first came to the city, I couldn't believe that companies don't actually have an official forecast. They just have to use analysts in order to their numbers are agreed with the analyst. I mean, we see that all the time. And that's another aspect I don't think that's widely understood. I think it would be better if companies just had a forecast.
That's some companies do it, and in Europe it happens, in Germany it happens, but it obviously depends on the profile of the company, because some companies have no visibility at all, right? It is horses for courses, and that's part of the job of an analyst, is to sort of contextualize that.
You know the kind of conversations we have here, honest, ambitious, and focused on what's really shaping the future of UK industry. Now, imagine taking them even further. That's exactly what the Digital Forge membership is about. This isn't just another network, it's a proving ground where connection, knowledge, and opportunity collide. As a member, you'll unlock exclusive events and curated networking with serious builders, a private community platform for real-time support, and a content and knowledge hub packed with insights you won't find anywhere else. Plus, you'll gain access to exclusive discounts and the chance to learn directly from mentors and seasoned founders who've already walked the path. Everything we do is built on trust, clarity and intent. No noise, no theatre, just the right conditions for progress. So if you're ready to join the future of UK industry and step into a community built to accelerate growth, join other members at forgedforgrowth.com.
So last night we talked about, at the Digital Forge event, which we did a fireside chat at, we talked about the state of capital markets, of the stock market in the UK, and I mean, the stats better than me. I mean, we've gone from 1,600 companies on AIM to 600. The amount of liquidity, the amount of cash available to invest in companies is chronically low. Yet we don't have a capital shortage, and we discussed this at length last night. But I'd like to discuss it again now. That we have huge trillions in pension funds in the UK, most of which is invested overseas. I think the number's somewhere around 4% is invested in UK equities, 90% probably invested in US equities. How do we fix this? Is this a problem? How do we fix this problem?
That's the lack of capital in UK equities is a problem, and it's a problem. I think this, it shouldn't be about fixing the city. It's about the point of the city is to provide growth capital to entrepreneurs and growth companies, and for the benefits of that growth to be enjoyed democratically, right? And certainly the lack of capital going, or actually the outflows from UK capital, has been the fundamental problem, right?
Yeah.
And a lot of behaviours and everything have stemmed from that lack of capital. It's resulted in people being more risk averse, because you can't come to the market to raise growth capital and so on. The good thing is that there, at a lot of different levels, people recognise that there is a problem and people are working at solutions. And certainly in terms of the pension fund money, I mean, there is the Mansion House Compact, which where I can't remember how many pension funds have committed to allocating a greater portion of their funds to the UK, not in listed equities, although it's unclear whether AIM and Aquis actually sort of classify as part of that. It would be good if that initiative was expanded so much and that public equities got more of that pie. There are reforms encouraging better retail participation in fundraisers. There needs to be a focus on financial education to get people to, if you're going to put some risk capital in an investment, to put it in equities rather than Bitcoin or just US stocks, but you do need to educate people in terms of the returns, but also how to make those picks. And there are a number of other things going on. So I think there are a lot of people working at improving the picture, and actually it doesn't take much to start to move the dial, because if you get a bit of extra capital in, what happens is stocks start to re-rate upwards, which means that right now, because there's not enough capital in it, the UK, everyone recognises the UK is a cheap market in terms of price earnings and the metrics, and the US is, it's expensive because there's a lot of capital come in, and they've also got amazing growth companies. Let's be frank, they're incredible at building, growth companies. But if you get if evaluations start to improve, then more companies will look at IPOs as a route. It will become less expensive for companies to actually raise money and do things like invest back in their business or make acquisitions. And if stocks go up, then people see it's going up and they're more likely to come in. So we need to create a virtuous cycle there. We do hear that overseas investors are looking more seriously at the UK, and that we are starting to see some fund inflows in some places. We need to keep working at it. We need to keep on making it better.
What signs should we look for? What green shoots should we look for that would indicate that the market is turning?
Yeah, I think IPOs. There was the Raspberry Pi IPO last year, which was successful. It's a really nice company. It's gone well. I think seeing some good IPOs come to market and be successful, good quality businesses. One of the key things is we want to readdress the outflows, because so many companies have been bought by private equity or US buyers, but equally we don't want a massive flood in the market where quality thresholds go down. So just a steady stream of good quality IPOs coming to market would be very helpful. And just signs that some of the small cap funds are actually getting, they need to get their money from places, and that investors are putting their money into those funds, so that those investors have more capital to invest.
Do you think UK fund managers understand tech? That's a broad question. To what degree do you think they understand tech?
Most UK fund managers are generalists.
Yeah.
That there are tech fund managers. We've got good tech fund managers. There's Herald, Polar Capital Trust, Allianz. I still got Allianz, but there are good tech fund managers, but they don't just invest in UK equities. If you are going to be focused on a sector, then you have to have a big enough field of vision. So you need to really be global. Yeah. Especially given that I think tech is now less than 10% of the UK equities in the market. So most UK investors are generalists. So when companies are thinking about this, they've got to put in place the messaging and the advisors and the analysts. Where the analysts is to help them explain their business to a generalist audience, and retail are the same. So really having a think about how you explain your equity story, you explain your technology, and make it easy for people to analyze. There are investors who are very good in tech, and there are some who just find it too difficult. And I think there is a risk that we miss out on significant structural growth drivers like AI, for example, because people think it's too complex and too fast moving, and and these are the things that create the huge shifts in value creation. One of the things we do say though is that for companies that are listed, it's not just UK institutions should be investing in you. There are US investors who can invest down the market capital scale, retail investors, family offices, and so on. Broadening your visibility to all of those specialists is very important. And actually, particularly retail now. I mean, retail is around about 50% of all active management in the UK. So actually, retail investors are playing a hugely important role in setting the price. And for some companies, they are setting the price. So don't starve them of information, right? I mean, often people complain about retail investors saying, especially when the stock goes down, it's just retail selling.
Yeah,
it's like,
exactly.
Nobody ever says it's just retail buying when everyone wants the credit when companies go up. But they are starved of information a lot of times. I mean, a lot of times retail investors can only really see, recommendations and price targets, and they don't see all of the context and the detail behind that in terms of the analysis. So how are they supposed to make an informed decision? And I mean, that's one of the things we do as a business. We make our research available to everyone, but you don't starve your kids of an education and call them stupid. So give retail investors that information, that ability to analyze you.
One of the things that used to frustrate me is that share price would move, say, 10% up or down, and in low liquidity, low volume trading, it's just trading. I mean, people say, are you being acquired, or are you going bust, or whatever? And it's like, well, no. All that's happened is a fund has decided to buy or sell, and because they need to, because they might have had redemptions or something else, and that's all it is. How often do you see that? Do you get those calls?
Yeah, we do. I mean,
mainly retail punters that.
It can be. I mean, and it's particularly prevalent right now. Is that there has been a lot of forced selling in the market.
Yeah.
If fund managers have redemptions whereby investors in their fund are taking money out, then they need to sell, and often they don't want to sell. A stock, but they have to prioritize them and say, look, if we're going to sell something, it's got to be this one, and it's not always a function of upside potential. It can be liquidity, and risk, or is there just a buyer available? So there are a lot of the lack of liquidity is an issue, and there are distorting factors, and I think. My personal view is there's been a lot of negative distorting factors that have impacted the UK market over the last 3 years, and it'd be nice to see some positive ones.
Well, I mean, maybe an unfair question because it's maybe oversimplifying something, but do you think we have an innovation problem in the UK or an investment problem in the UK, or is it a little bit of both, or is it neither?
I don't think we've got an innovation problem at all. We always, the adage is we are great inventors. We don't commercialize it. But even if you look at artificial intelligence, on a sort of balanced scorecard, we're sort of number 3 or number 4 in the world in terms of innovation, in terms of VC investment, patents, and so on. Yeah. There is, the lack of capital is an issue. I think the big gap. And small cap equities as part of this is in scale up capital.
Yeah.
So it's the ability to scale companies from being startup to small, medium, and then ultimately large companies. That's the big missing piece of the jigsaw, and everyone realizes that. And there are people raising scale up funds now. A healthy small cap stock market is part of the equation, but not only. The listed route isn't the right one for all companies, and it is one of those cause and effect things, because if you haven't got a good scale up infrastructure and ecosystem, then founders don't found their businesses to scale. They've found their businesses to sell to a large US company.
Yeah,
and they run their business that way. And what we need is more founders, creating their businesses with a vision of, growing it to a 500 million, 1 billion, 10 billion business, and ultimately trading on the stock market.
Well, we don't have a multi-billion-dollar tech business in the UK right now. We haven't created one for a very long time. Is it
not listed?
Not listed. Yes, correct. Is that a capital allocation problem?
Is that a capital allocation problem?
Because they can't get scale up capital. Are they selling?
I mean, I think. Well, part of the problem is we have had them, but they've sold.
DeepMind, yeah.
DeepMind, and then even when they are listed, people like Darktrace, which is actually similar, stable to Autonomy, has sold. So we haven't. So I think I'm not sure if it's capital allocation or it's just. I think it's the lack of focus on structure or belief in structural growth, and also it's not just not having enough of them, right? If you've got 4 or 5 of them, you can make your choices, and there'll be more people who want to go along for the journey. I think a little bit the issue is the generalist structure of our market, in that because everyone's generalist, people tend to be structured by just size of the company, or growth, or value, and so on. But that means when naturally a company outgrows the remit of the investor, then they have to sell their shares, which creates so therefore people will happily take a 30% premium or 40% premium by a strategic acquirer, whereas having a more of a sort of continuum whereby people will take it on and invest in the growth story is important. I do think that encouraging companies to go out and just meet international investors and meeting those investors who will be in there for the next leg of the journey and will want to support them on that journey is a piece of the jigsaw as well.
So how do we fix this? You're the Chancellor of the Exchequer. What do you do?
I think the fundamental issue is the capital issue. Yeah. I mean, there are the different elements, but we need to do lots of things. I do think the government is doing good things, and the predecessors actually. Everyone realised that regulation had become a problem, and there was this move to sort of. I think it's Bim Afolabi described it. You don't want to be the safest graveyard in the world. Regulation is sort of it's important. You need it, but we need to reduce that burden and encourage growth and an appetite for risk and growth. I do think that a small change in pension allocations could make a lot of difference, and it doesn't have to be it doesn't actually have to be a huge change, right? So, the UK pensions, and I do think we need to back ourselves more. So that would be the number one thing. It'd be sort of taking that a step further to ensure that we're backing ourselves and we're investing more of our pension funds into UK business.
It's one of those that what I'm going to try to do is to build awareness that this is going on, because if most people that have pension funds would not want it to be allocated to they wouldn't just care solely about
them, right?
Yes,
because if your pension fund is all going overseas, then you're not investing in the next generation.
Correct.
Right. The next generation of people.
Yes.
Need people 20s, schools, pension 20s, 30s. All of those people need to grow up in an environment where there is investment going in and there are opportunities. And by starving the UK of that investment, you're starving the next generation of opportunities, right? And I think there needs to be the recognition of that.
Yeah.
And I think they are starting to recognise it, but I think certainly, making you're right. If you say to the people who ultimately have the pensions or saving that money up, right, what do you think about this? Then I think majority of them would be supportive, right?
And fund managers hate intervention. The city doesn't really like intervention since the 1980s. But if they can't do it, does it require intervention? Do we just say, actually, we're going to carve out 5% of this $2-3 trillion pension pot that's been 90% of which is going to the United States? Do we force it?
I think the time is right for that. I mean, they might get there, but it's got to happen we need it to happen quickly.
Yeah, the Mansion House thing is it may affect Aquis and AIM, it may not, we don't know yet. But it's 10 years. It's not enough. That's we need it now. Brilliant, Dan. I mean, we've covered a lot of ground there, and I must say it's nice to be talking to you rather than the other way around. You've got so many interesting things to say. Who knew? Anything else you'd like to add before we close?
Oh gosh, that's a wide open question. Look, it's a pleasure to be here. I really appreciate it. The Digital Forge event last night. I think it's an important thing just to bring people together, investors with entrepreneurs, north to south, get the dialogue going. And we're not going to moan our way out of this, right?
Yes.
We're going to make our way out of this by being positive, ambitious, having an appetite for risk and growth, which everyone wants, right? But the problem is when there's no capital, then everyone becomes too risk averse.
Yeah.
Just generally, I think events like this and forums like this are very important. Just for getting everyone talking, getting more people aware, realizing that there are things we can do to improve the situation. And we've got so many wonderful entrepreneurial companies coming up in the country, and the stock market does need refreshing.
Yeah.
We absolutely need some newer, innovative companies onto the stock market. A stock market that lacks structural growth companies structurally underperforms, and that's in part the reason why the UK has underperformed. We've sold our biggest structural growth companies, so we need to refresh that. We need more structural growth companies coming onto the market. We need to realise that those companies aren't going to come on at super cheap multiples. To the point, Arm always looked expensive, but it was a great company. Now, obviously, you can't dress up every single company as at a high multiple. Those multiples need, the valuations that companies come to market need to be sensible. But if you're going to bring good quality companies on, then they need to get the valuation that they deserve for that quality.
And thank you for coming up from London last night. One sort of final question from me. We don't have a culture in South Yorkshire. I was going to say the north. There is a little bit in Manchester and a little bit in Leeds, but we don't really have stockbrokers in this part of the world. So trying to bring capital here and connecting with some of the great companies and great ideas and great innovations. What's your perspective on the sort of regions in the UK, and how is the city too focused on the city in London?
Yeah, I don't think the city is. I mean, the city wants to make, they want to make money. This is the city, but the quid pro quo of the city is that you make money from helping businesses grow. That's the fundamental purpose, right?
Yeah.
I think it's a bit of a two-way thing. And we discussed this last night, is that people don't look towards the city. They're seen as different animals. I think genuinely, if companies came down, they would find the reception they'd probably find people more receptive than they think.
Yeah.
For companies with good ideas and so on. I mean, it doesn't mean they'll get the capital, but we've got a great industrial heritage in this country. I mean, a lot of the look at Rolls-Royce and Halma and all these people.
Yeah.
People realise that we can do this, and we've got great tech expertise. I think people are. I think people would find the city receptive, with the context that with the caveat that people have got to realise that you will meet generalist investors as part of that, and they you will need to make your story clear and apparent to them. But it's sort of nudge theory. We need to, like you've done with the event, nudge the city up towards us and nudge them down, towards London. More face-to-face meetings. All of these things will help. But a bit of push either way, I think, be helpful.
Dan, that's been absolutely brilliant. We've covered a lot of ground today. The secret language of the city and your job in decoding that, how we fix the stock market, how we reallocate some of UK pensions that's unfortunately going overseas back to the UK, and then how the North can start participating in capital markets. Thank you so much.
It's been a pleasure. Thank you, David.
What if your aligner system could drive more profit for your dental business? With PureTech Clear Aligners, our AI-powered software delivers instant smile previews. Our custom aligners, proudly made in Sheffield, arrive in just days, not weeks. Patient wait times are reduced with localised labs, and our revolutionary technology offers smoother workflows, higher conversions and happier patients. Be part of the future of aligner care. Start your pilot today at puretech.ai. PureTech Aligners. Smile brighter, smile sooner.